And welcome back to halftime. Let's get to our calls of the day. Morgan Stanley calling Blackstone one of the best plays in the golden age of private credit. What a title there. The bank saying Blackstone looks compelling globally and is well positioned for growth. Shares are up right now over 1%. And Jason, you just bought Blackstone last week.
I did. I think private equity is really interesting right now. Blackstone raised $53 billion in equity last quarter, $25 billion the quarter prior, and they have $200 billion, which is a record for them in dry powder to deploy. So I think there's an opportunity as well in private credit as clients and investors look to diversify, from an asset standpoint. So I like this one, and I think they're poised to move.
So Brent, I know you have a lot of exposure to private equity and private credit as well. What do you think about Jason's buy?
Yeah, I think it's a really smart buy. If you think since the great financial crisis, all of the ways the traditional financials the finance companies, the banks used to make money, have now been switched to the private equity firms, whether they're private credit, private equity, real estate. These big firms are doing that underwriting. And so I think if you think about what Jason said, $53 billion they raised, they get 2% management fee with a 20% carry over time. They're just printing cash. And so I think within financials, people need to look outside the traditional banks and look to a company like a Blackstone, which also I think has like a 3% dividend as well. So I think it's a really smart play for the next few years as they capture that 2% and 20, which goes right to the bottom line.
All right, Josh, you have some exposure as well with Carlyle?
Yeah, I said so the funny thing about the golden age of private credit is that's actually an internet meme that they made the title of the research report.
Oh, really?
Yeah, this is what 28-year-old guys that work at like these firms walk around at cocktail parties, and that's how they're picking up girls these days. Can I tell you that right now is the golden age of private credit? It's an Instagram thing. But bigger picture, I agree with Jason, and I do think that there is opportunity in these stocks because the allocations in wealth management, in family office that are going increasingly toward alternatives are probably not stopping anytime soon. And these are the best of the best. I happen to own Carlyle, which is not as large as KKR and Blackstone, but from my perspective, that's the opportunity. I think Harvey Schwartz, being the new CEO there, someone who's got a tremendous amount of experience and contacts all over Wall Street, is set to make a splash and has something to prove. And I think that Carlyle is really well positioned alongside Blackstone.
All right, shows the Carlyle up just over 0.5%. We want to move on to FedEx now. Reiterated as a buy by Deutsche Bank. The firm admits it expects another tough quarter for FedEx, but it still sees a sizable opportunity. Jason, you're in on this one.
Yeah, so I mean, it was a tough quarter, obviously the last quarter, and the price action hasn't been great over the last 3 months. It's down around 7%. It was down around 12% after earnings, right? So new management team, recommitment to shareholder value there. I think e-commerce and the consumer are going to be tailwinds for them going forward. Right. So, I think you got to stay tuned. Industrials continue to break out. I think FedEx is one of these ones that you got to just be patient with.
Other side of the coin, headwind. You already cited the slowdown in China. They're heavily levered to China. So concerned about that at all?
No, there's definitely concern there. But I think as it relates here to the States, with e-commerce re-accelerating, you see the Amazons of the world and other retail players. I think you have to just be patient with this one.
All right. Last, certainly not least, we're going to go to CrowdStrike. Oppenheimer removing it from its top ideas list. By the way, CrowdStrike hitting a new all-time high today at the same time. Josh, you're in on this one. Actually, shares down a bit right now, down almost 1%. But Josh, what's your take?
So I bought this in November of 2020. It's up like a lot. And, this is a great example of outlasting the bastards because this stock got absolutely creamed in 2022. But now look, like the market has changed around. 3 months returns, 60%. 6 months, 120%. 1 year return, 187%. Why? It's not magic. This company's growing its revenue faster than almost any other company in the entire software group, doing so profitably, not even in the S&P 500 yet, because they spent most of their time as a public company unprofitable and therefore not even considered for inclusion. Now it's been discovered. People are like, oh, wait, it looks like cybersecurity enterprise spend is not at risk because, oh my God, it could shut down an entire company if they get breached or hacked. Yeah, you figured that out today? So a lot of people have been riding Palo Alto and CrowdStrike and Fortinet. There are a lot of winners in this group. I think they keep winning. It doesn't mean they go up in a straight line. So I would not be a fresh money buyer of the stock right this second, but I'm also not a seller today.
Yeah, big tailwind for the stock. Also, new SEC regulations on reporting cybersecurity.
Yeah, public companies now literally have to demonstrate what they're going to do about breaches, and if a breach happens, they have to be talking about it with officials within like 48 hours. CrowdStrike is going to implement that and do that work. It's just one more tailwind for a company that's got tons of tailwinds already.